Welcome to Investing Uncensored. I'm your host, Andre Stewart. And you all know I love bringing on venture capitalists or people that can tell us how to make money. But I'm really excited about bringing on this guest. He has done some amazing things. He's been featured in Wall Street Journal, Forbes, you name it, he's done it. And you're going to find out why. So I want to let you guys, get firsthand information from somebody who's created or was a co-author of the Jobs Act. If you don't know what that is, you're about to find out now. Woody Neese, how are you doing?
I am great, Andre. Good to see you. Thanks for having me.
So happy to have you on. It's, a struggle, probably the longest podcast scheduling in history, right? But it's going to bring some good information for the listeners. And so one thing I want to do is what I always like to do. I can give a whole bunch of accolades about what you've done, but I'd rather you give people insight on what made you, take the path that you did with becoming a venture capitalist. What's your background? And what made you want to be one of the co-authors of the Jobs Act?
Sure. Let's unpack that. There's a lot to unpack in there. I started my career on Wall Street, did not care for trading bonds.
Mhm.
I went out to California and worked in Silicon Valley for a startup there that was venture funded. It grew into quite a large company. It was called PeopleSoft that was acquired by Oracle.
Mm.
I learned a lot about why VCs invest in businesses. Was fascinated with the whole culture of VC-backed companies. At that time, my family had a dilemma where my niece was born. She had a bilateral brain hemorrhage. She couldn't take her medicine. My sister and brother-in-law were struggling. Brother-in-law is a pharmacist. He used flavors to flavor the medicine. And at the holidays, I was just like, you need to turn this flavoring of medicines thing that you're doing for your customers into a business. So he started doing that. And then I got to the point where he's just like, I need help scaling it. And I said, I will come on as long as we can try and take this thing to the moon.
Mm.
And so I tried to take everything that I learned from Wall Street and Silicon Valley to running our healthcare technology startup. I was CFO. We were venture backed. We sold it to a private equity group in 2007. And there was a funny thing that happened in 2008 called the Great Recession. It was at that point, and by the way, we were living in Washington, D.C. That's where the Flavor X was, the healthcare company. So we, I just sat down with two friends of mine and I said, DC is looking for jobs. Clearly, we've all created businesses that have created a bunch of jobs, but the problem is access to capital. And these laws under which we have to raise money are antiquated. They were written in 1933, and there's
Mm.
been some updates in the 1980s, but we need to update them to the internet age. And so we wrote the framework for investment crowdfunding. All my friends in DC worked on the Hill.
Mm.
So I knew people that worked on the Hill. I knew Karen Kerrigan, who ran the Small Business and Entrepreneurship Organization, the closest thing that small businesses have to a lobby group in Washington, D.C. She hooked us up with all the right people, the staffers really that we needed to speak to on the House Financial Services Committee and the Senate Banking Committee. And three of us as entrepreneurs walked the halls of Congress, testified in front of five Senate and House panel hearings, and it turned into a law in 460 days. And we got to the White House. And that launched this $3 billion industry that's 10 years old. We started a database that collects information on all the companies raising money through it. People can raise up to $5 million online, but we saw the opportunity now as VCs. So how do you leverage all this data on all these startups that are raising money? How do you take in new signals like investor sentiment, meaning how many checks go into an offering each day? How much total do those checks add up to each day? And then how do we use that through an AI driven algorithm to decide which companies in this crowdfunding ecosystem we want to invest in? So then that turned us into venture capitalists along the way. And so now we have a venture fund called D3VC that takes all the work that we've done to date and all the experience that I've
Mm.
accumulated to date and turns it into a hopefully engine for creating intergenerational wealth down the road.
So for those of you that probably need to be caught up on what he's talking about, when you're trying to get funded, a lot of people know, I think the percentage of venture capital is that fund the deal is what I think it's 2%. It's a very low
Right.
number of people being able to get funded. So what they did that was so amazing, if you've never heard of something called WeFunder or StartEngine, if you have a company, doesn't matter, and I've gone through this process when I created an Invest for our mobile app. I went through WeFunder and StartEngine to get my app funded. But maybe you've even done something like well, no, I'm just going to stick with WeFunder and StartEngine because that's more so along the lines of what he's talking about. Because you have Kickstarter and all these other type of funds, but it's not per se what he's talking about. So if you go back to it, so if you have a company you're trying to get funded, the Jobs Act allowed for people like us, regular people who can't get funded by a VC for 1,000 different reasons, to go online and take our idea and let just regular everyday people invest $50 to $100 or whatever, and you get shares. So you can simply own shares in a company by just putting up $100. And I don't know if it's how some so every platform is different. So you don't have to have a minimum that you have to invest, or you don't have to do some kind of like weekly type of disbursement into the platform or whatnot. But he created something that's so amazing because now a regular person can own these companies that before they even IPO. So just imagine
Yeah.
being able to get in front of like Apple or Tesla or one of these companies before they even hit the market. And that's what the Jobs Act was, and that's why it's so amazing that him and three entrepreneurs were able to create something like that for us to be able to fund companies like mine or yours without having to worry about getting funding from a VC.
Yep. And you know what I love about what we created, which I had no clue when we created it, is the up to 50% of the people that are coming online to raise capital right now are women or minority founders.
Correct.
Okay. Clearly, they do not get any reception in Silicon Valley. And so they're able to go to their communities that
Mhm.
in many cases look like them, and say, hey, you know me, you know what I'm doing. If you think that I can grow this into some scalable business, maybe you want to be a part of it. And to see the successes that are happening with them in 2,300 cities across the United States is amazing. But to your point, like the logic just wasn't there. Like when I was running FlavorX, we had mothers would call us because they got their kids to take the medicine, and they'd be like, how do I invest in your business? Like my kid hated medicine and you
Mhm.
guys solved this problem for me. And I was like, unless you're rich, you can't.
Mhm.
And I said to my friends and the lawyers, I was like, this is such a like an obviously missed opportunity. Like if
Correct.
these mothers could become investors, they become brand advocates, they bring more sales in, probably more investors. Like, why do we have to live under these laws that were written in 1933? So the logic was there. It just needed, a group of people to be determined to get it done. And, we had a good narrative and we had a lot of tailwinds on Capitol Hill.
I laugh because I brought on maybe four VCs, and I always ask them the same question because I know as a minority founder that I think it's like a 0.1%. It's very low when minorities getting funded in Silicon Valley. And I worked in Silicon Valley. I worked at Silicon Valley Bank for quite a while. So like I understand that space, but from you being a VC and having a different experience, what is your experience on why do you think that is the case with minorities or women owned businesses not being able to get funded?
Well, Silicon Valley is a closed network. Okay. So it's who do you know? And the people in that network stay and fund each other with big checks. And to break into that network is virtually impossible. So you're already excluded on that front. And then on top of it, most people don't live in Silicon Valley.
Correct.
A lot of these entrepreneurs are just spread across the United States. Silicon Valley invests in companies that are mainly within 60 miles of Silicon Valley. New York City VCs do the same thing. So you see this buffer zone that's sort of built around these ecosystems, and that's just not fair
Mhm.
to these entrepreneurs that don't have the ability to move to Silicon Valley or New York City, but have very creative ideas. So the law that we created really leapfrogs that. It allows anyone to raise money from anyone. You can raise it from both, your average American. You can raise it from, rich Americans too, maybe that hear about what you're doing, but you're not precluded. And so, we've pushed that out of the way. And what I really, really love about it is VCs pay attention to this now.
True.
So if you've got an African American entrepreneur or a female entrepreneur that has started a business and has raised a significant amount of capital from 200, 300, 400 investors, these VCs that are like, well, what do they know that I don't know? Like,
True.
why did they gravitate toward this business? Why should I be looking at it now? And so it's created this new way for them to come into these deals that they probably would have never looked at before, and with interest because they want to know why other people are so interested in it. So these investors, they validate these products, they validate the market, and they just help all around.
One of the things that you hit on the head is like investors are taking notice. One thing I do know, being on WeFunder, you have a lead investor. You kind of always have to have a lead investor, I believe, on WeFunder and StartEngine, and that might be $50,000 before other people can jump in. But then you'll notice that if it's a heavy hitter, you'll see that their company name. So I've noticed on a couple of deals that I've looked at, and to let everyone know, it's not like these deals on WeFunder or StartEngine are just getting $1 million. I mean, some of them are going to 50, 100 million. It's crazy from the stuff that you can see. But like he's saying, you will see that there's investors from the major players that are in Silicon Valley that are on these platforms looking for products. So if you do have a product
Mm-hmm.
that you're trying to get funded, obviously they're going to focus more on tech. But I have seen some restaurants or some T-shirts that have gotten funded on that platform. Just to give you context.
Beverage companies,
Correct.
all of that. You've got healthcare, biotech companies, startups that are raising money, and you're just traditional technology software companies. AI is huge right now. I truly believe the future unicorns in the space are going to have their initial funding journey through investment crowdfunding.
I love it, and it's funny because they kind of have this for real estate that came out, but then this was the next wave. But like when you guys came up with this idea to do this, do you know what was the first company that came out that was like a start engine that was able to do this?
Like the first regulated crowdfunding platform,
Correct.
the first ones were Seed Invest,
Oh
StartEngine,
yes, Invest.
WeFunder, Republic.
Mhm.
They are still, well, Seed Invest was acquired,
Correct.
but the other ones are still the largest platforms to date because they were really the first ones in the space. There's been 170, believe it or not, platforms that have registered with the SEC. There's about, on average, there's probably 80 active platforms, but on an individual month, there's probably 30 that are doing any deals.
Whoa, that is a lot. So then, for anyone who's like myself, I also have another. I'm gonna send it to you. I know I have an AI platform that I recently created, and that we're launching it into the app stores as we speak. I can't say the name of it for 1,000 reasons, but I want to send it to you just to see because you guys have a platform, and let's touch on that once I ask you this question because I'm curious for people that are interested in getting into a seed invest or like a start engine or a WeFunder, what kind of advice do you have for them to get on there and get funded? Because even when I put my app on there, it wasn't like I got immediate attention or immediate traction. So what
Right.
kind of advice do you have for someone who does have a company that's trying to get on there and do what you're talking about?
So we wrote a series called Investors, and there's two different books in there. This first one is a 400-page mantra that tells you everything you want to know about why this industry got started.
Mhm.
It's a really good bedtime read. But if you're an entrepreneur and you want to
Mhm.
know how to succeed, this one's like the playbook.
Okay.
It's 150 pages. It's literally a one-day read and a step-by-step guide to how to raise money successfully on these platforms. I tell people all the time that if you are looking to raise money through investment crowdfunding, the number one thing that you have to do before you even get started is build your community. Because crowdfunding can't happen without a crowd. So this is not a fishing expedition where you go out into a lake and you throw out a net and you catch a bunch of fish. No, you actually have to know these people before you actually raise money from them. And you actually have to build a relationship with them before you ask them for capital. So you need to know them, they need to know you. You have needed to build a product or service that they're engaged with. Hopefully, you're doing social media awareness. Hopefully, you're sending emails out. Hopefully, you're blogging about the problem or solution that you have and engaging an audience. And then you're cultivating that audience. And then once you have that audience, then you sort of merge the opportunity to raise capital with that audience on these platforms. But you really need to socialize it with them beforehand and say to them, if I do one of these offerings, would you invest? How much would you invest? And that's what we call soft circling. It helps you get an idea of where you might net out in your offering.
That makes sense because that's exactly what when I was gonna do mine, that's what the advisors were saying. Like, do you have a podcast? Like, what do you have that you can send out a blast to get people to even come and fund your
Hmm.
platform? And matter of fact, I don't even think that WeFunder or StartEngine even open up your offering to everyone else on the platform until you hit a certain amount of people in your own circle. I do think StartEngine was like, once you hit 100 of your own investors from your own list, then we'll open it up to our user base.
Yeah, and on top of that, these platforms are also restricted as to what they can do by law. So a lot of them aren't allowed. Like if you're just a crowdfunding platform that's not a broker dealer, you can't do solicitation. You can't rank offerings. You can't be pushing deals as the best deal. Broker dealers can because they are overseen and more detailed by FINRA, and they've got more flexibility to do that, but you're going to pay more if you do a deal on a broker dealer. But the WeFunder and the StartEngines and the Republics, they want your deal to succeed because the more you succeed, the more money they make in terms of commissions. But you're right; it's not an open platform where
Mhm.
just because they've got 30,000 investors, and by the way, 2.1 million people have written checks into investment crowdfunding since this industry started. So I'm sure they have a lot more than 30,000
Yeah.
investors.
Mhm.
But they're not sending all of these deals. And there's between 75 and 150 new deals a month. You can
Correct.
think how annoying it would be if you're just receiving all these emails like "Give me money, give me money, give me." Nobody wants that. So they are selectively deciding which of the deals they want to open up because you've gotten traction, you've gotten validation, you've gotten a lot of money already committed. And so that's where they see, like, okay, let's send this, if you're a life sciences company and you're raising money, and then they're like, okay, you've hit these metrics. Let's send it to people that have invested in life science deals on our platform. So it's
Correct.
very strategic because it helps. It cuts down on the noise, and it really helps these raises focus on raising money from people that have invested in similar type of deals.
And it's funny because to his point, like the acceptance rate is like 4%, right? I think StartEngine even sent me an email and they were like, look, we like the idea. You have to go through a whole entire process to even get selected to be even put on the platform. So I don't want you all thinking, oh, I got an idea. Let me just go hop on WeFunder or StartEngine. No, you still have to go through a process, but it's an easier process than to get funding from a VC. I think the average is 51 to 71 meetings you have to even get the meeting with the VC. So that the context with that, we're trying to go the traditional route versus you may be doing this online on a computer, talking to different people trying to get on StartEngine. And then from that point, so it's still a process, but it's a little easier, a little better for you. And if you do have a good product and you do have a good network, at least you have a platform like that you can blast it out. And then maybe if you do well, then you have access to millions of other investors if they like your idea.
And by the way, Andre, like one of the things that we tell people all the time is if you're interested in doing this, go onto these platforms and look for deals that might look like you.
True.
Okay.
Yeah.
Because
Mhm.
see what they're doing, see which ones are the most successful, and see what you can copy of their success. Because to your point, you have to apply to these platforms.
Correct.
They already know what success looks like because they got
Mhm.
the deals there. So if you can mirror your offering, you don't, you're doing something specific. So you don't want to say, I do
Yeah.
this when you don't
Yeah.
actually do it. But what I'm saying is, you want to have your look and feel of the deal be something that they're going to be like, yes, I can see this on our platform.
Correct. And that's kind of what I did. I will give you guys this tip too. Start Engine is really hard. That's probably one of the hardest ones. They acquire seed invest, like you said. So they're really hard. But then WeFunder is a little bit more flexible. And the one thing I did like about WeFunder is that once you get on the platform, they'll let you build a profile once you get accepted. And then you can send that out to your network. And then once you get to the point of where you hit 50,000, then they'll open the platform up and then they'll have a deeper conversation. So if you do want to just get something to where you have a link that you can create a whole entire executive summary and all of this other stuff, then I would say go the route of WeFunder. And then maybe once you get to 50,000, then re-engage that conversation with somebody that works there.
Mm-hmm.
So then one thing about the Jobs Act, and then we can move on. When you came up with this idea, was it something that you all were struggling with getting funding, or it was just like you just saw a need and you guys decided to fix it?
I mean, clearly in 2008, the capital markets were looking for a solution.
Correct.
And so there was a need in the marketplace for this. No one had tried to do it just because everyone was told you can't.
Mhm.
So it took three naive entrepreneurs walking the halls of Congress to actually get this done. But when I was running Flavor X, we raised money from first we did a friends and family round,
Mhm.
and then we raised money from VCs. And it took us a solid year to raise the money from venture. It
Mhm.
was painstaking. I was flying between DC, Boston, LA, and San Francisco. When they tell you raising money's, another full-time job,
Yeah.
it
Yeah.
takes you off the ball.
Correct.
And it was very annoying. Now we partnered with some amazing venture capitalists in LA that I'm still very good friends with. We were lucky in that way. But most people don't have the connections. Most people can't get on the planes and do the flying around. And by the way, crowdfunding is both equity and debt. We've got these two
True.
platforms that are leaders on the debt side. You've got Honeycomb and the SNBX. They really facilitate debt crowdfunding. So if you're an entrepreneur and you want to raise $100,000 and a bank won't listen to you because banks don't really lend very
Mhm.
well, particularly if you're under 3 years old, good
Mhm.
luck. These platforms do a phenomenal job of letting you raise money from your communities.
Mhm.
And I see tremendous success and innovation happening thanks to these platforms there. So, if you're listening and you're thinking, I've got a small business, does this work for me? Absolutely. Don't just think this is an equity type of thing. There's opportunities for, entrepreneurs on both sides.
Agreed. And one thing I'll say about this, and we can move past it. I also went through the experience of trying to raise funds, and I just stopped because I think I was doing it right before the pandemic hit. So that's one reason why I stopped. But I also noticed what you said. You have to just keep going and keep going. And if you're a solo founder like I am, then you take away from being able to generate actual revenue to help keep your business going regardless. And so that's
Oh
one thing
yeah,
that you got to keep in mind. It's going to be really hard to get funded, but do the trade off. Does it make sense for me to try to go out here knowing that the odds are against me, or do I just put my head down and bootstrap it and just do what I do, and then get to the point of where I have a really good product to where I can go on a WeFunder to get validation because if they accept you, then you must have something. And then I will say that the friends and family round would probably be your best bet to get an idea on like, do I have something? Because your friends and family, depending on who they are, might tell you the truth. But if they don't want to
hmm
invest, then what's the likelihood of somebody else that don't even know you wanting to invest in your company? That's kind of what I
right.
would say. If your mom or your grandmother or cousin is like, if they don't want to give you $50 for it, I mean, it's going to be tough for you.
Oh yeah.
So then, with your the company that you have now, and again, AI is taking over. Well, let's talk about that. What's your thoughts on AI? I've been using AI so much in the last couple months, and then just there's so many apps out there that allow you to be a software engineer. You know what I'm talking about. So like, you've analyzed over 10,000 deals or more.
Right.
So like, what's your thoughts on AI, and why do you guys have such an interest in it? And is this something that your VC firm is looking for right now?
I mean, it's something we're looking for and it's something we use.
Mm-hmm.
So when you've got a data set as large as ours that has 8,400 companies that have done over 10,000 offerings, we collect up to 150 data points in each offering. When you do the math, it's about 5 million data points in our database.
Mm-hmm.
It's very, very hard for you manually to come up with a methodology
Yeah.
to do the analysis in a very quick and systematic way. AI has streamlined that entire process that allows you to pick pieces apart and
Mm-hmm.
give weights and um, more interest in one variable over another.
Mm-hmm.
And so that's what we've done, where we're using AI and machine learning to build algorithms to analyze the data. And what you do is you don't take an old data set and you analyze it. You take new data that's coming in, and you've built this algorithm that says, look for these signals in companies
Mm-hmm.
that are coming in that match other companies that have graduated to another round of financing. Okay.
Mm-hmm.
And if they match, ding, 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 put it to the top of the list. Maybe we should be looking at that. So that's the type of algorithm that we created, where it takes in the new data, it retrains on the new data to be like these are different types of company coming in. Most of them are larger, more established, more revenue, and it looks through this, and the signals evolve. But we get a prediction score every week of the top companies in there. And by the way, that prediction score we let anyone have through our Capital Pulse report that anyone can subscribe to. So if you don't want to look at 600 active deals, you can look at what we say are the top 15 each week. But what it does is it really speeds up the process for where do we need to be focusing our attention. And at that point, once you have that list, then you start doing the things that traditional VCs do in terms of diligence. You need to get to know the team, which is not very easy to do through quantitative research on these platforms. It's very qualitative. You need to go through the offering documents and dig out more details on the valuation and all that stuff. We do tag for women and minorities because we want to see what's happening in that space. So it allows us to look at things very quickly and then diligence them where we see the opportunity to then make our own investments.
So is your platform similar to like a WeFunder or a Seed Invest, or is it something completely different?
It's a D3VC is a traditional venture capital fund. So, it's funny. Today, I actually wrote a LinkedIn post or an article about why the missed opportunity investment crowdfunding. We've created this law that allows startups to raise money online, but it has to be an operating entity. I remember when we were lobbying for this in DC, there was pushback. Well, our venture funds can be able to do this. And at the time, I was just like, if you don't want them to be able to do it, I think they should. We can just exclude them. So they were excluded. And I was just like, in retrospect, that wasn't a good idea because you've got early stage fund managers that are out there that, again, don't have the traction, don't have the relationships in Silicon Valley, precluded from access to massive capital that could really crowdfund from their friends. So our venture fund is a traditional venture fund. It can only have really accredited investors be a part of it. We don't, we're not on a WeFunder platform raising money because it's not a Reg CF offering. It's a 506C offering. So I'm actively trying to both change that law. I'm pushing to raise the cap from 5 million to 20 million right now in DC. So we spend, we do data, policy work, everything.
Yeah, that's pretty cool. That's crazy how you were a businessman and just end up getting into dealing with something like this. You just can't stroll into Congress and be like, hey, I got this plan here, right? So that takes a lot of skill. So then with your VC firm, how many deals a year do you all do? Because I think on average, most VCs only do like 10 to 12 deals a year. So what do you guys do as far as deal size? And then how many deals a year?
Yeah, so we've only been at it for 1 year in terms of actively investing. We built the algorithm. It took us a year and a half to build that. We tested it for a year, investing our own money. And then we formed the fund and we started to invest in it. We've been capital constrained, which is really the reason why we haven't done more deals, but we've done 25 deals to date. And our goal is to do another 175 over the next 2 years. But we're actively out there raising money for it so we can complete that. We've been really, when you run a fund, you can only mark your performance to the most recent valuation. And that's what makes it hard for funds to actually talk about how they're doing. But in those investments that we've currently made, there's been 4 companies that have already gone on for a follow-on round of financing at a higher valuation, which has been great for us because we've been able to show that it's had what they call 1.18 times MOIC, or multiple of invested capital. That's what we think is a great positive initial traction for year one, because you don't really start seeing this until year 2 or year 3 with these companies. And then the other thing that I love is we're actively tracking these companies over time. The average revenue of these companies between when we've invested and their annual report for their next year has been 169%. So these companies are growing. That's what you want to see too as an investor. There's lots of positive signals in the space. Like any venture fund, you want to invest in a diversified basket. Our basket's going to be much bigger than a traditional VC fund because many of them are like 10 deals and they aim for one outlier. We're doing hopefully 200 deals. Hopefully we'll have like 20 or so that are really good, and hopefully we'll have one, two, or three outliers within that. So the researchers from MIT and Harvard have written all these studies about the more deals in a portfolio, the higher the returns. And so we're just following that pathway, be like, okay, we're not going to invest in 20. Let's go for a really crazy amount of 200. But we need more capital in order to complete that vision.
I mean, that makes sense because it's a numbers game, like anything, right?
Yeah,
So if you're only doing 10, then likelihood of that is 10%. You're only going to get one, like you said. So
right.
with that being said, if you guys are going after that many companies, what's going to be your check size, minimum check size, and maximum, I guess?
Yeah, right. So we're not writing the big checks.
Mhm.
Our goal is to put $10,000 to $25,000 into each of the deals that we're investing in.
Mhm.
25,000 when we're a lot of conviction, 10,000 where where we have good solid conviction. But there's been deals where we looked at it and been like, well, maybe we split 10,000 over two education software companies because
Mhm.
we don't know which one's going to be a winner.
Mhm.
But we think both of them have potential.
Mhm.
So we also look at it that way too. So, but I would say between 10 and 25, maximum 25.
So then,
But
go ahead. Go
I'm
ahead.
sorry. Yeah. I was going to just say, but the point that we've noticed too is it's just once we make a decision to invest, it's validation that we've actually put skin in the game.
Mhm.
And people that follow us too, if they're not in the fund, also invest. And they invest just by following us. If on WeFunder, you've probably seen, people, you have a profile and people can follow your profile.
Mhm.
And so they can see what you've invested in so they can follow that.
So then I have two questions real quick. Then with that WeFunder or Seed Invest, will you guys put money into that platform if that person's like, hey, I'm doing this on there, can you put this money here? Because that'll give a signal to other people that someone put 10,000 in, which would help them out. Or you just rather write the check to them directly? And
No, we actually want to support the industry. So we invest
Mm,
directly on the crowdfunding platforms.
that's
So
good.
you will see D3VC and our logo and all that on these deals that we're investing in.
That's really good. So then my second question to that is, what particular type of companies are you looking for? I know you want to do AI, but are you looking in education? Are you looking in tech? Like what are you looking for?
We are sector agnostic. So
Oh,
you can be healthcare, life sciences, you can be software, you can be food and beverage, you can be, clean tech.
mm,
What we're looking for is solid teams with experience, hopefully, an exit or some sort of fundraising that they've done in this industry before that they're operating in, that they've have a protection around whatever they've developed. So they've got some IP to protect what they're doing. So it raises the bar to competition. That they've got a customer acquisition pathway. And by that, I mean, life sciences has to go through multiple cycles before they're going to actually be revenue generating because if they're FDA process, they've got to go through clinical trials. There's ways in which you can show progress and milestones leading up to that that'll make us think this is a company we want to invest in. But on the flip side, we follow revenues because
mm.
revenues are attached to customers. So we want to see how your revenue growth has been, what your traction has been, who these customers are that are getting your deal. If you're doing those type of things, that will also, it'll raise what you're doing in terms of the scoring and the algorithm, and it'll help us in our decision to make and invest in your, investment decision in your company.
So then for everyone listening, they're not looking for startup, like not day one. I'm assuming you're looking for something like 6 months and maybe a certain amount of customers, 100 customers, maybe I don't know, 100,000 in revenue. Are you looking for something like that, or is it more experience or more than that?
I mean, we do invest in pre-revenue startups, plenty of them, because a
Okay,
lot
okay,
of the healthcare companies we invested in are pre-revenue. We don't invest in ideas, to your
oh, okay,
point.
okay, got it.
So if you just have an idea and you're like, this is what I want to do, we're not going to be the right people for you because we need to see that the how it's going to scale. And the way in which we see how it's going to scale is through the relationships that you've made with distributors, customers, that type of traction that you've made there. So if you have a letter of intent with Whole Foods or Sprouts, if you're a food service related company, or if you beverage and you've got a distributor contract with one of the major beverage companies, or if healthcare and you already have one of these pharma companies saying we'd like to express interest in licensing this product. Those are signals that we follow. So that's where you want to focus on, how do I get those signals that'll help me get the attraction of the VCs that might be interested in investing in the company.
So this is great. I'm asking some of these questions for our listeners, but also myself, because I do have a real estate tech company that I didn't exit because I didn't want to, because in my mind, if you build a platform and I funded through friends and family, a good amount. So then after that, I just started making revenue. So then most of the time when people are scaling businesses, they need the revenue to scale the business. But if you're already generating revenue and you want to grow faster, then maybe you might go out and raise funds. So in my situation, I didn't go out and raise funds. I could make an exit, but I don't want to because I'm already profitable. So it wouldn't make sense. Could I take
Right.
more money to scale and go faster? Yes, I could. But the other company that I started, which is in healthcare, which is kind of why I want to talk to you about it. Looking at my background, you might be like, how did he go from real estate to healthcare? But you'd have to know my background to understand that. But I want you to look at this. I think you might be just from a standpoint. I would want to know hear feedback from you on this particular
Yeah, send it
platform that I
along.
created, because it's still early. Like I'm literally just launching it now, but I want to get your feedback because you've seen thousands of deals, so it would be good to hear
Right.
someone's opinion and perspective on it.
Yeah, no, we've looked at all 10,000 deals. In the past year, we've diligenced about 275 of them, and made those 25 investments. So
That's
even if the algorithm points it to the top, it's not like we're going to be investing.
that is insane. So
Yeah.
10,000. This is it like? What did you guys use to create? I know it's AI, but did you take like a platform from somewhere? You got in-house engineers, or like, because I mean that's insane to take that much data and do that in a
We
year.
have 3 data science PhDs on our team,
That is wild.
and
That's good.
they know how to take this stuff, slice and dice it, create algorithms, test it. The important thing about an algorithm is not that you have it, but that you can test it and then um, push back against it. So a lot of times we'll look at a deal and we're like, well, how did the algorithm score it in these different areas? Because we're like, why would this deal pop at the top? What did
Mm-hmm.
the algorithm see that we didn't see? So
Mm-hmm.
we push back on the algorithm. By the way, when you do this stuff, I didn't know any of this, but you retrain an algorithm. We retrain our algorithm twice a year. So the way it's
Mm-hmm.
operating right now is very different from the way it operated when we created it 3 years ago.
I didn't know that. That makes sense though, because it's machine learning. So you gotta know where it learned, the more you gotta optimize it to make it more efficient. That makes sense.
Yeah, yeah. I mean, just as like a 6-year-old knows a
Correct.
certain amount, but once they're in high
But it's
school,
still
they know even
steering.
more. But when you're in college, you know a lot more.
Correct.
And then unfortunately, when you turn into people like you and me, you know too much to your own good.
So much. So true. So then, with that being said, when can a founder or a person know that their business is ready for crowdfunding investment? I know I gave my 2 cents about it, but what do you think?
Yeah, I mean, I would just tell anyone, go on these platforms. Look, if you think you're ready, if you've got that traction, the customers, if you've got a community that you believe will back you, go onto these platforms, see if you can see similar type of deals. There's an assessment that you can take, this pretty cool free assessment on offeringinsight.com, and it'll actually let you know if you're crowdfund ready. That actually has a 10-page report too for people that really want to know what platform, how much they can expect to raise, and all that stuff. So people can fill out that form there and get a full report on which platform is right for them and their valuation, all that stuff. It's super interesting. Again, how all this data is being used. But that's what I would tell people to do. Read the book, go on the platforms, look for the deals that are similar to you, socialize with your community that you want to do this, and then reach out to the platforms. To your point, they're not all going to say yes.
No, no. If you can say that web address one more time so people can.
Offeringinsight.com.
We will put that in
OFFERINGIGHT.com.
the caption or in the description so you guys can click on that. I'm going to use it, so I think you guys should too. So then I'm all about mindset because, and most people think that people that have VC firms or people that are rich were just born rich and they had a bunch of money and that's how they did it. And most millionaires weren't that. Like, if
Mhm.
people knew the statistics behind that, I mean, and then most of them are C students in college or they dropped out. So
Right.
then my first question is, how did you get to the point of the mindset to where you have? I know you became an entrepreneur, but how did you get to this point? Did you come from money, or you just what was your process of getting here?
I was raised by parents that said no, and you can't. And my entire childhood was why not?
Mhm.
And I'm the youngest of six, by the way.
Oh man.
So I know my oldest sister has a very different mindset than I do. So I think my brain was always focused on why can't we do something?
Mhm.
Which is why when I left my Silicon Valley to start the healthcare company, my parents were like, with my brother-in-law nonetheless, like, what are you doing? This is crazy. And I was just like, it's my life. I'm going to do whatever I want. And I was out of the house. And then when it came time to writing the law, again, my father's like, you can't write a law. And I was just like, all right, fine. Just watch me. I'm okay if I fail. I fail. You have to have that mindset of, why not? Am I going to give it a shot? This whole industry it's persistence and determination. It's exhausting. If you're an entrepreneur, the words
Oh
that I
my
just
God.
said are in your blood. Like it's annoying how this is unfortunately the world that we live in, but someone's got to do it, and that's
Yeah.
why we were made to be the people that we are, because this is what drives us to why we get out of bed in the morning, what brings us happiness. A lot of people are like, this doesn't sound like it's would be the happiest thing. You're like, are you kidding me? I
Yeah.
love what I do.
Yeah, that's true.
It's just it takes a certain unique type of person and a determination and just a happiness.
I always tell people, like, people see online entrepreneurship and them, like, you have to have a stomach, you have to have the mental capacity. There's a lot of things you have to be an entrepreneur. Sometimes you know how the cycle goes. You go in
Oh
waves where you're
yeah,
like, I hate this, I'm done, I'm giving up, I should get a job. You go through all of this, but then you're like, I can never work for someone, right? Once you've been an
right.
entrepreneur for so long, you're like, I'm not going back, I'll do whatever I have to. So you just deal with those highs and lows, but I don't think people get that. And people are always like, people that are entrepreneurs are mad at people that have jobs, and people are mad at people that have jobs, are mad at entrepreneurs. But it's like, once you do it, you
Right.
just know before you get out there what it's gonna be like. So I mean, even
Hmm.
so, you worked in Wall Street, and this kind of will lead me to the next thing. You had to transition out,
Hmm.
right? So what was your job in Wall Street, and then did you have a plan? Like, I always tell people, have 6 months of reserves, and then at least have a pipeline of deals coming in, because if not, it's going to be so
No,
hard.
yeah.
So what did you do for your transition out?
It's funny. I got my MBA, and if you knew me when I was getting my MBA, my sole focus was, I'm going to Wall Street.
Mm,
I'm going to Wall Street.
mm,
And my uncle worked for the UBS, Paine Webber. And again, relationships get you in, and he got me in at a low-paying job only because I wanted it, and I wanted to work for them. And they're like, "We'll hire you, but we're not going to pay you much." And I was like,
mm,
"I don't care. I just need to start on Wall Street."
mm,
And I calculated the P&L for the government trading desk, which is bonds. And I automated the whole thing with an Excel spreadsheet. They were doing it manually before. But I was sitting in this really big open room. Like, if you've seen the movies, it's like a big fishbowl,
mm.
and you've got all these traders,
Oh yeah.
and the outside of the entire thing were these glass offices. And I would see them walk out like these managers and pick someone up and take them into a glass office, yell at them, like reduce them to tears, and then escort them out of the building. And I was just like, I don't want that for my life.
Yeah.
And so I was just like, this isn't a career for me. So I transferred to the retail side in San Francisco. And lucky enough, the branch manager in that office looked at me. He's like, Woody, this is not your calling. And I was like,
Mm,
yes, it is. He's like, no, this is not your calling. And I don't know if you ever have read this book, but it's called What Color is Your Parachute?
mm,
Um, the branch manager gave me the book. He's like, this book is going to help you figure out what your calling in life is. And I read that book. I did all the exercises in the book, and that's what led me to the job that PeopleSoft in Silicon Valley. I left the East Coast, went to the West Coast, moved in with a roommate, wasn't making any money. Got my job on in Silicon Valley, and then slowly started to work my way up. But then took the job as an entrepreneur and went down to making nothing again.
nothing again. Yeah.
And then built that business. And it's like you have to, like you said, you have to have the stomach for it.
Yeah. It's funny because you had the same story that I did. When I worked in the bank, my branch manager was like, "You're just wasting your talent. What are you doing here?" And I'm just like, "Really? I thought I was doing good." But he was like, "No, this is not what you're supposed to be doing." And I'm like,
Right?
and then 6 months later, he gave me, I forgot the name of the book he gave me, but then I was gone. And I'm like, man, he was right. And so then he
Yeah,
told me I should be doing exactly what I'm doing now because he compared me to Steve Harvey. He's like, you got a personality. You could be this. You could be doing this. I don't know why you're doing
I
this. And
love
he's
it.
right. I left. I ended up writing 3 books. I got a podcast. Like he was right. So people see things in you that you don't see in yourself, which is
Right.
amazing. So you should take that. If someone comes to you with that's crazy that you had the
Yeah.
same experience that I did. So then what 2 books would you recommend someone read? That's what I'll ask.
Well, I don't know if I want to be selfishly say these two.
You got to do that.
um, but outside of that, I don't, I have read a lot of business books. Like Good to
Mhm.
Great is
Oh
just a
yeah, yeah. That's a
phenomenal
good one.
business book on like how these, GE and Fortune 500 thinks and operates,
Mhm.
and lessons from, how you go from a good idea or a good company to a great company, and how you surround yourself with A-level players.
Mhm.
And then I was part of Entrepreneurs Organization, and Vern Harnish
Oh
wrote a
yeah.
book called Rockefeller
The
Habits.
habits. Yep.
And that book, when I was running Flavor X, was instrumental in helping us focus on scaling the business.
Mhm.
Those are, two sort of different ones. But honestly, I think you need to balance all these books with ones that are good for the mental side too,
Mhm.
or just listen to Insight Timer and get a good meditation in.
You're gonna need that, I swear. On those rough days,
Right.
because you're not making money every month. Like some months you
No,
might make nothing, and then one
right,
month you might make 100 grand. Like it's crazy how it works.
right.
So then, I appreciate you for coming on. I mean, if there's anything that you can leave the listeners with, from your own experience, or people that want to be entrepreneurs, or people that want to, obviously see if they can reach out to you to get funding.
Mhm. So you've heard me talk about a lot of different things. It's too much for me to list a bunch of different websites. So we created one landing page called investomersbook.com. So
Mhm.
it's the title of the book, Investomers, with book at the end.com, investomersbook.com. And there are links to everything. So if you're interested in raising money online, I would tell you to go there, and look at all the different resources that we have available. It'll point you to that offering insight report. It'll point you to the book and all that stuff too. That's where I would go. But learn, spend the time. If
Learning.
you think
Yep.
this is right for you, go onto these platforms, see what success looks like. Hey, you know what? Invest in one of these deals.
Mhm.
Take $100 and say, would I put it in one of these deals? You will learn a ton just by deciding, am I willing to give up my $100 and put it in this? Because now you're putting yourself in the mindset of the investor. That's such a valuable lesson right there. And the most important thing you can do is scroll to the bottom and read the comments that people are writing on these deals, because you will see what people, when people put up these deals, there are really smart investors that are looking at the deal and they're asking questions on these platforms. So go down and see, you might not be a PhD in data science, but there probably is some PhD in data science that's looking at a data science deal on one of these platforms. and is asking questions to the CEO that go right over our heads, but you're like, ooh, that was a good question. Let me read the answer. The most important thing you can do is, if you're putting one of these offerings together, is be communicative. So that's before you put the offering together with your potential investors. When your offering is live with the people that you're trying to get investments from, and then once you close, you better keep on that communication channel with your investors and leverage them for the power that they can be on your cap table.
100%. I mean, that's you hit it on the head. I'm a master practitioner of integrative psychology, and one thing that you're breaking down now is people need to understand their relationship that they have with money,
Yeah.
right? And most people don't know that. So like the way you invest $100, if you're like tight about doing it, or you're like, I don't know, that's a good indicator of like, can you be an entrepreneur? Because it's going to take a lot of your money up front. Or can you invest like a Warren Buffett? Or do you have the stomach to do what he's saying and try to, be early in a platform that if you put the money in, that $100 could turn into $10,000. You know what I mean? So I think that's a good strategy for everything that he just said that you all should do, because it'll give you a real good indicator of who you are as a person, and if you do have the
Mm-hmm.
stomach for what we're talking about.
Yep.
So, um, anywhere that you have any content, I know you talked about Twitter. Anywhere else that people can hear from you or see what you have going on?
Yeah, you can follow me on TikTok. I've got a TikTok channel where I am making videos and all that stuff. It's Sherwood Neese is the TikTok, and then on you can find me on social media on LinkedIn through Sherwood Neese and connect with me there. And then if you subscribe to our newsletters, the links are in the on investorsbook.com. You can get lots of information on everything going on in the world of crowdfunding.
Uh, Woody, it's been great. It was a great conversation. I hope everyone learned, but it was great having you on. We'd love to have you back in a couple months, but I am going to send you my new product because I do want the feedback. And I look forward to having you on again in a couple months.
Thanks, Andre. It was really, really fun to be here, and I hope this was a learning thing for everyone.
For sure. Thank you, sir.
Thank you.